Hello, everybody. Welcome back to my series of videos debunking velocity banking. Before we actually do that, there are several terms used in the finance world: personal finance, banking, lending, credit cards, that we have to understand and agree on to have any useful dialogue or discussion about personal finances, loans, banking, and velocity banking. So let's get into the video and do that. Again, as I've stated before, many of the velocity banking videos that I've seen incorrectly use or incorrectly define these terms. And I've never seen the promoters or the content creators actually devote time to defining the terms. They just say, "Hey, this is what I'm doing," and everybody assumes that you agree with their term or that they're using the terms correctly. So I thought part of my video series should actually include, let's actively define all the terms that we're going to be using. And here are the points that I was just making. Important to keep in mind, point C here, these concepts are everyday terms that are applicable to everyone. They're used in the banking industry, finance industry, credit cards, like all these terms I'm using are the actual definitions of these terms. I emphasize that because you go on the Velocity Banking channel and you leave a comment, or I have, and I say, "Hey, I think you're misusing this term." And the response I get back was, "Well, I'm using this term my own way. It's my own definition." Or I read a book and this author used a term this way, and I'm using that definition. There are certain things that are objectively true and objectively false, and a lot of times, the definition of simple interest or compound interest is objectively, one way or the other. And you can't really go around and start applying your own definition to terms like this. So that's what we're going to do. Terms that we're going to define: cash flow, loans. Seems kind of silly. However, I see a lot of videos where they say, "Oh, a loan is different than a line of credit, and a credit card is different than a loan." And, overall, loans are loans, and we'll cover that in another video. Interest rates, how you calculate interest, why you pay it, how you pay it, and the amortization of loans. Amortization of loans basically means you have a loan, you're going to pay it off over several years. How does that process work? That could be for a business loan, a student loan for college. It could be for a car loan. It could be for a home loan. All right, so those all work the same. Those are slightly different than, I mean, there are a lot of differences than paying off a credit card or revolving line of credit, but we'll take a look at examples for that as well. So this video is going to focus on topic number one, cash flow, and I'm gonna break up into several parts so we could do loans, interest, and amortization, just so I don't have one big long video. I'm going to do smaller chunks of videos so that they're more easily understood and more digestible. All right, cash flow. What is cash flow? Cash flow is basically your income minus your expenses. It's actually a very easy and simple definition. You have income, you have expenses. If you have positive amount left over, you have positive cash flow. If you're spending more than you're making, you have negative cash flow. Income, wages, salaries, gifts, investment income. Okay, like gifts, I'll say like regular gifts that you're receiving, let's say from parents or whoever every month. Investment income, if you're receiving that every month, that's money coming in. Expenses, basically housing, food, car, loan payments, insurance, rent if you're paying rent or mortgage, et cetera, et cetera. Your cable bill. I'm only listing a few here just so we can keep the examples simple. And that's money going out, right? So my income is money coming in, my expenses are money going out, whatever the difference is, that's my cash flow. All right, let's go through some examples. As I stated before, positive if you have extra money after paying all your bills that you can save, spend, invest, or use to pay down loans. That's positive cash flow. If your cash flow is negative, you're spending more than you earn, and your loans and your debt will grow each month. Okay, so if I'm making 1,000 a month and I'm spending 1,500, and part of that is on credit cards or whatever, my credit card balances are only gonna go up. Like I'm never gonna be able to pay that down. If I have 1,000 income and my rent, my car payment, my food, etc., is 1,500, I'm covering the difference with credit cards. I'm never going to be able to pay that down, right? Because I have negative cash flow. All right, let's take a look at some simple numeric examples. We'll start off with the income. Wages from primary job, $3,000 a month. Normally, you get paid on the 1st and 15th. Some people get paid on the 7th and 22nd. That's been a trend in the past few years. I don't know why or when it started, but the idea is most people, when you have your monthly income, you don't get it all in one check. You usually get it broken down. So if I have 3,000 in a month, I'm going to get paid 1,500 on the 1st, 1,500 on the 15th. That's going to be important later when I'm doing videos on debunking velocity banking, because they oftentimes show you numeric examples and they say, hey, you get 3,000 a month. Here's how you put that 3,000 into your credit card. And they fail to point out that you don't actually get 3,000 in one chunk. You get it twice a month, 1,500, 1,500. All right, expenses, and I'm limiting them. Housing, that could either be rent or mortgage. So I'm just doing a general housing. That's going to be special. Housing is special because most of the time you cannot pay your housing costs with a credit card, right? So I can't pay my rent or I can't pay my mortgage with a credit card. Now I know what you're going to say. There are services out there, and this is true, where you can use your credit card, pay the service with a credit card. They'll send a check to pay off your rent or your mortgage. However, you don't want to do that. They charge 2.99%, 3%, etc. For the service fee, and that's because of credit card fees, swipe fees, etc. All right, there is one credit card out there that I've seen which will, like, if you get their credit card, they'll allow you to pay your rent or your mortgage without charging that 3% fee. But most credit cards, most services which use a credit card to pay your fee, to pay your housing, will charge you a fee, which makes it not worth it. So housing is separate in my examples because you must pay with a checking account. Food, car, and other loans. Uh, Actually, car loan you can't pay with a credit card either unless you get charged a fee. And then other loans, same thing. You're going to be used for checking. So food, food, that's the one where you can charge on your credit card, right? Usually it's like food, cable, internet, telephone, but I don't want to list out like 20 expenses, right? So we have 800 for housing, 400 for food, car, and other loans. I'm just calling loans. I'm using that as a catch-all for credit cards, etc. So I have outstanding balances on my credit cards, and those minimum monthly payments total 300 a month. That's what that 300 is. Add them all up, 1,800 a month in expenses. All right, now we have a cash flow, income of 3,000 minus expenses of 1,800. That means we have $1,200 a month in free cash flow. That's money that we can do anything we want with. Okay, so I can go out and I can have a nice dinner. I can pay down some of my credit card loans. I can buy products in cash, cash or checking, right? The point is at 1,200, I don't need to borrow. I don't need to charge. I could still charge expenses on a credit card to get, rewards points and travel points. But assuming that I'm not doing that, 1,200 is how much I have extra per month. And again, if I have item D, loans, where I'm paying 300 a month because I've got $5,000 in credit card balances, I could take that extra 1,200 and pay down those $5,000 worth of credit cards. Again, we'll do an example in the future showing that. But that's what cash flow is. 1,200 a month, I can save, spend, invest, or pay down other loans and debt. Okay, cash, this is actual cash money. You'll see a lot of people say, well, if I have $400 worth of food expenses per month, instead of paying for my checking account, if I use a credit card to pay for that, I increased my cash flow. Actually, you have not. And I'll talk a little bit more about this later. If I use a credit card to pay, for instance, my food expenses, I have not increased my income. I have not decreased my expenses. I actually charged the 400. That's an expense that I have to pay later. So I actually have not increased my cash flow. All right, let's move on. All right, credit cards and lines of credit. Again, this is what I was already talking about. Cash flow is actual cash that you have on hand that I can pay for expenses or to pay down debt. Available credit on a credit card or a line of credit is available credit. What this does, it allows me to charge an expense and basically defer paying that expense into the future. I did not generate new income. I do not have any new cash that I can spend freely. And when we say spend freely, we mean, buy food or buy a product and not owe for it in the future because I paid cash or whatever, right? Once I pay cash for something, that product is mine. I have no obligation in the future. If I use a credit card to pay for something, I have not increased cash flow. All I've done is basically said, I'm going to pay for this expense in the future. I still owe money. I'm still obligated to pay for it in the future. Okay. This is more increasing future liabilities. This is not creating an asset. This is not creating cash on hand. I use a credit card. It creates a liability that I have to pay in the future. This is akin to increasing an expense. I am not increasing my income. Okay, so very important. Using a credit card does not increase cash flow in any way. Now you might ask, how can I increase cash flow? Cash flow, always remember this equation. Cash flow is income minus expenses. So two ways that I can increase my cash flow. Increase my income. Okay, let's say I do a side hustle. Everybody's talking about side hustles. I do a side hustle, I gain $400 a month. Again, these are just numbers just for arithmetic, mathematical purposes. You might find a side hustle for 100 a month. You might find that side hustle, you make 4,000 a month. Great. But that's one way to increase my income. I can get passive income from investments or properties. I can do more work. Increasing my income increases my cash flow. Okay, second part of that equation, expenses. I can decrease my expenses. That will increase my overall cash flow. So let's say I lower my food bill. Instead of $400 a month in food, let's say I eat out only once a week instead of twice a week. I save $50 a month. So my food bill decreases by $50 a month. Other possibilities, I can lower my cell phone bill, lower my cable TV bill. I might do an episode in the future just on personal finance on how I saved a lot of money by lowering my cell phone and cable TV bills. Those are possibilities. Again, decreasing my expenses increases my cash flow. All right, let's look at an example. My income, same $3,000 a month. For my primary job, I get a side hustle for $400. My total income is now $3,400 a month. Expenses, housing, still $800. Food, it went from $400 to $350. I decreased it by $50. And then car and other loans, credit cards, etc. I'm keeping all the numbers the same. So the only numbers that changed, I increased my income by $400. I decreased my food bill by $50 a month. My new expenses are $1,750. All right, cash flow, $3,400 minus $1,750. I now have $1,650 a month in positive cash flow. I'm making more income than I'm spending. My old cash flow was $1,200. How did I increase my cash flow? Increased my income by $400, decreased my expenses by $50. That's all cash savings, money that I'm no longer spending, or more money that I'm making in terms of the income. Now I have $1,650 instead of $1,200 that I can save, spend, invest, or pay down loans. And here we have some additional comments. $450 increase, income by $400, expenses by decreased by $50. And these are the main points from our discussion on cash flow. Income minus expenses, cash left over after all my expenses are paid, including charging new expenses on credit cards, etc. Debt tools, lines of credit, credit cards do not increase cash flow. So again, if I have $350 or $400 in food expense, if I take a credit card and use that to pay for my food expenses, I have not increased my cash flow. I have not basically put any more money in my pocket that I can freely spend. All I've done is I've deferred those expenses to a later date that I'm then going to have to pay. Next video, we're going to discuss some terms having to do with loans. And again, it might seem kind of silly. You say, oh, I know what a loan is. But again, a lot of videos I watch, they'll say, here's a loan. That's no good. Here's a line of credit. That's great. Actually, loan, line of credit, maybe a better word for this would be debt. Like in either case, these are vehicles used for debt. So maybe I can change this instead of saying loans, I call it debt in general. But whether I'm borrowing money on a credit card or on a mortgage or a car loan, all those items are loans. Yes, a credit card is revolving debt, but basically I'm borrowing money from a bank to pay bills or to pay them in the future. That's a loan. If I borrow money for a car, that's a loan. If I borrow money for a house, that's a loan. Anyway, we'll get into that in the next video. So I hope this was useful. Please like, comment, and subscribe. And again, validate my information. Look up your own, do your own homework. Look up your own information online. If you have questions, suggestions, ideas, I'm more than happy to take them. Please leave me some comments in the comment section, and I will see you on the next video.